Facebook Live Finance Show. This is episode number 79. Today is Tuesday, September 22, 2020. This is the 39.6 Facebook Live Finance Show, actually now being broadcasted live to YouTube at 39.6, 39 POINT 6. Thank you. If you're out there and can hear this or see this, please let me know in the comments. I appreciate it. This is the show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, childcare, other household expenses, and even the car you drive. Today is episode number 79. So when we relaunched this a month and a half ago, that was episode number 30, I believe. So this is the 50th episode we have done in a row. I haven't missed a day. We've done 50 episodes in 7 weeks. So that is super exciting. I am so glad this has continued and that we've been able to grow our community. If you are hearing this on YouTube, if you want to join our community on Facebook, it's 39.6 community with a decimal point 6. And this is where you can ask questions and I will hopefully answer them. So today's question comes from John in the group. And he says, I would like your take on syndication deals with dual share structures. For example, Class A preferred equity and Class B common equity. I'm seeing more of these offerings and don't understand the appeal to the limited partner. Why would you invest in an illiquid asset, locking in your capital for 3 to 7 years as a preferred equity with no participation on the upside, parenthesis, refinance/sale, and parenthesis, with potential loss of principal? Why not just invest in a first lien secured hard money loan as an alternative? That's for Class A. Now for Class B, why would you limit your preferred return and increase your risk of investment loss by having more layers above you in the capital stack in the event the deal tanks or underperforms? All right, so these are fantastic questions. And for those who are not familiar with the capital stack, I discussed this in a previous episode. What is the capital stack? And that was back at episode number 40. It feels like forever ago. So episode 40 is very important to review if you have never heard about the capital stack, but it's the order of operations in terms of where the money goes. And it doesn't really matter the order when everybody's getting paid and everybody's happy. But when money is short, then somebody has to get paid first. So it's like you have a family, you have a baby, you got a toddler, you have a 10-year-old, you got a 16-year-old, and you have 2 adults. And you go out hunting for food. You come back with your food. You have to make sure the baby is fed. After that, you got to make sure the toddler is fed. Then you got to make sure the 10-year-old's fed. Okay, they all have to get fed before the teenager or the adults, because the teenager and the adults, they're probably mostly done growing, right? They can starve a little bit. You can't really have that baby starve. That's not good. Okay, so every step is a priority, and mortgage debt is the first priority. Okay, so that's in a nutshell the capital stack. There's an order. Now, to address this question directly, so first, I want to bring up some things. A term hard money loan is something that I use when referring to loans that companies give to people who are flippers. They fix and flip houses. It can be really for anything, but that's what I usually use it for. And these are companies that charge high interest, high points, usually 3 points origination fee. So like 3% of the loan is due upfront. Okay, then they charge often like 15% interest for as long as you hold it. So if you hold $100,000 loan for a year, you would pay $3,000 up front and then pay $15,000 at the back end. That's very expensive. If you were to have the same loan for 6 months, it would still be $3,000 up front, and then you'd pay $7,500 because it's only half a year of interest. Okay. That to me is a hard money loan. And that's often for people who are in the fix and flip space who haven't really built out their network yet. They're probably new to the game. People who are more experienced have a network of other people who are happy to invest money with them called private money lenders. And I do private money lending. Also, my wife and I, we use our Roth IRA money for private money lending. And we just actually, somebody just reached out to us today about a deal offering 2 points and 10%. So 2% of the deal is 2 origination points plus 10% interest for as long as they hold on to it. And those that's a very fair rate. It's cheaper than hard money. Hard money is expensive. Private money is cheaper, and you deal directly with the person without an intermediary involved. So it can be a little bit cheaper, and it's based on having these relationships. And I like doing secured first lien position private money lending for a portion of my portfolio because you do have a limited upside. Okay, and I did discuss this previously when I talked about L bonds and corporate bonds in general. I don't like high yield bonds because the upside is relatively limited and you're taking on equity type risk. But when you have something that's secured by an asset and you're getting it at a good valuation, so this deal is like a 70% deal, so 70% of the after repair value minus cost of repairs. So there's a lot of margin for it being safe. So if things were to go bad, I have first lien position, I can take the property and I have a lot of margin there to sell it and still get my money back. Actually, White Coat Investor, I was really impressed. He discussed this topic on his episode from last week, I believe. And he invests in a debt fund with first lien position fund. So you invest money and this company, they do flips and they have first lien positions. And it's interesting because he calls it high yield debt, and he had the same comments that I did about having limited return, but it is secured, and ultimately it's debt, but it has potential to be equity because if that lien, that mortgage doesn't get paid, or the loan to you doesn't get paid, you take it over and now you're in an equity position. You own this asset and you have to turn it into money and make profit. So you need to have a company that is able to do that. And I have had some experience on the fix and flip side, partnering with other people, and I have a large network of people with whom I would not have problem finding in order to basically get a deal done. If I were to have to take over that property and foreclose the other investor or the person who's borrowing money from me, I could partner with somebody else, get the property finished, sold, and make a profit. Okay, so but you can make good money. I've lent at 2 points and 12% before, and this one's at 2 and 10, and that's very fair in this interest rate environment. So that's a very good interest rate. That's like 12% if they hold it on for a whole 12 months. If they only hold on to it for 6 months, it's actually higher because 2 points spread over 6 months is actually a 4% interest rate. So it'd be like 14% interest. That's really good money, good return on your investment. And it's very secure because it's first lien. There's no other bank holding a mortgage to it, but there has to be margin. There has to be space between the retail value and what you're buying it at so that there's margin for you to sell it even at a discount and still make your money. Okay, so if you're doing private money lending properly, then they say that the worst thing that can happen is that you get paid your principal and your interest back because you have a lot more upside if you take the property over. But granted, there's more work involved there. Okay, so why not just take a high interest position as private money? So first of all, you have to understand how private money is dealt with from a tax perspective. So you can calculate your effective return and correlate that with the amount of risk you take. Okay. Debt is charged as ordinary income. So if I lend somebody $100,000 out of my own taxable brokerage account, my checking account or whatever, I loan you $100,000. I charge you 2 points and 10%, and you borrow for 6 months. I get $2,000 up front, and then I get another $5,000 6 months later. okay, because you borrowed $100,000 at 10%, but you only needed it for 6 months, so half of the year. So I got $7,000. That's pretty good return on my $100,000. That was $7,000 over 6 months, $1,167 per month on average. But that will all be taxed as ordinary income. So that $7,000, I pay 37% tax on that. So I would only get 63% of that $7,000. So that'll be like $4,410, I think. So your net return, even though I got a high return on interest, it was a 14% return, 14% minus 37% tax is 14 times 0.63. That's almost 9%. So it's still a good return, but it could have been a lot higher. So that is why I do my private money lending inside of a Roth IRA, because then I can get that full 14% if they're keeping it for 6 months. Okay. So that's a great position to be in because you can capture all that tax, and it gives me some asset class diversification in that I have some debt in my portfolio besides having all equity, because you don't want to have, let's say, all equity, right? Because equity risks, even though you can diversify them, are still equity risks. Now, he brings up a good point. So a lot of deals have had these two-tier common stock or two-tier structures on the equity where, for example, we talked about Element 41. It has Class A shares that are 9% pref with no upside, just 9%, versus Class B shares, which are 7% pref and 70-30. Okay, so let us take the Class A shares, 9% preferred rate of return. So this is equity still, but it is a preferred rate of return. So you're going to get that money paid to you before any of the general partners get paid. It's going to be one of the highest levels once the debt is paid. Okay, so it is inferior to a first lien position. That mortgage is the first lien position. Now 9% with as equity in a syndication is going to give you shares. And when you have those shares, you're going to be entitled to having those K1s distributed to you annually. And those K1s will have your pro rata portion of the tax liability or the tax benefit. Okay, so let's pretend you're a full-time real estate professional and you get this gigantic K1 from the from the bonus depreciation. And so even if you have a Class A share in that position, that 9% comes to you, you're not paying any taxes on it, at least not currently, because of that negative K1. But if you're a full-time real estate professional, you can actually potentially take that loss, apply it to your ordinary income for mega losses, gigantic tax savings, potentially at a very high tax bracket. You cannot do that when you're in a debt position. Okay, so if you're in a debt position, you're just getting debt, you're just paying ordinary income if it's in a taxable account, or you're just taking the interest tax-free if it's inside of a tax-sheltered account. So part of being, if you're using taxable money, that equity position is very tax efficient. However, the thing I don't like about the Class A position, 9% straight up without the upside, is that when the property is sold, there's still depreciation recapture, okay? And there's not any additional money to sell, to get back to you as an investor. So you don't have additional money that you can use to pay for that tax liability the year following the sale, with exception of the principal that's returned back to you. So you'd have to dip into that. But you're still getting a 9% return. But if you're paying 25% depreciation recapture, you take 25% off of 9%, that's like 2.3% or so. So you're down to like 6.7%. So the return is like 6.7%. So it depends what you're going to be able to do with that negative K1. If you're going to be able to use that negative K1 to offset highly taxed income, that can be a gigantic tax benefit to you, okay? If you're investing as private money lending, not inside of a tax-protected account, then you're getting like 9% potentially. If you're turning properties over every 6 months, doing 2 points and 10%, But that's also assuming your money's always out invested all the time. So one of the benefits of being in a syndication is that these assets tend to be held longer term. Okay, with private money lending, if you're doing individual peer-to-peer lending with an individual person, you have your money on the sidelines between deals. Okay, now if you invest in a fund, okay, so White Coat Investor invests in a fund, like I mentioned. I don't know what fund it is he uses. I would like to find out. He might have mentioned it on a previous show. But there's funds, I think like AHP, I think that's what it's called, which I've considered doing as well. And these funds do similar types of things. If you're in a fund, you can keep your money in there longer. Okay, part of the problem once you get into a fund is, you lose a lot more control. And then there's liquidity issues. There's also liquidity issues in peer-to-peer lending, but once that deal is done, you get your money back. If you're in a fund, they can have a lockout period for a period of time where you can't get your money. And it's highly variable. So you can shop around for different things that have different characteristics, but you have to weigh everything from the safety of the deal, plus your return gross and plus your return net, and what those tax benefits are to you potentially outside of that deal. Because people are investing in deals just to get the K1s because they just want to take all these losses, which is a little bit scary. It does make me wonder if there's a balloon here, because I see people doing deals just for the K1s or just for the losses, which means that prices are going to get pushed up, right? That's how they stimulate the economy, by changing these tax laws, which incentivize people to spend more money on something than they otherwise would have, and prices go up. But this is going to sunset in a couple of years. So then what's going to happen? Okay, so we discussed the Class A shares, that 9% flat, straight up, with no split of the equity at the end, just 9%, no upside. Part of the other thing I don't like about just a straight flat percentage without any additional is that if the property sells quickly, what does that share get for all of the time they had? Because if it sells, let's say, in 1 year, and most investments require people to put the money in before the deal closes, and it could be out in there for like a month or two before it closes, and then it sells in a year, and the general partners and the other investors who have a split of the equity position get a higher percentage, a big profit, like they could double their money. You're still just getting 9%. So that is something that is to be considered. Now, a lot of these deals are not going to turn over in 1 year or 2 years, but they could, especially if cap rates compress. Or the opposite, cap rates could be going up quickly. For example, after the sunset of the Tax Cut and Jobs Act's bonus depreciation rules change, cap rates could go up a lot faster than expected, and people might want to exit deals sooner to prevent losses, and so they could get out of the deal, and you could just get your 9%. So that's part of the issue. It would be nice to have a little bit of a kicker. Like you could get 9% per year and then have some sort of accrued interest in addition that pays out at the end. I have seen a deal that does like 1% per year accrues, and then you get 1% that extra at the end. So it'd be like 9% per year, but if they hold on to it for 5 years, you get another 5% at the end. So you get a little bonus. So the longer they hold on to it, you get a little bit extra kicker. But it's still just basically a flat percentage. Now, that position is definitely safer than being in the Class B position, which is paid out afterward. Now, different deals are going to have different allocations of those Class A and Class B shares. A lot of times people don't really want those Class A shares, so they end up being a minority position, the ones that just give a straight percentage, because it's a lower potential return at the end. People who are retired, however, that can be super attractive because 9% cash flow, tax efficient, it's pretty nice, okay? In a relatively secure position, not debt secure, but one level beyond debt. Now, Class B, it's like 7% and 70-30. So at least there's still a preferred rate of return here. And the 7% preferred rate of return is not bad. I see a lot of deals where there is no preferred rate of return at all. is just straight equity. Like you're all in at the same percentage. The general partners take 20% or 30% if they're really good or have a good resume and people trust them. And they're just going to get 30% of everything or 20% of everything straight up. And so you could be getting very low returns. You could be getting like 3% returns, 4% returns. It just depends on how much is bringing in and what that split is. And the problem with straight equity to me is that the sponsors are not as motivated to perform. Because if they don't have to meet a certain number in order to get paid, they might just be okay with getting below pro forma returns if they have another deal that's putting money into their pocket, and they can just get another deal and another deal and another deal that all sub-perform. They're still getting paid a lot because they're getting a portion of underperforming assets. If there's a preferred rate of return, in this situation like 7%, albeit it is below the other layer, that 7% still has to get paid before the general partners. So it puts more confidence in me that 7% is going to get hit because the general partners want to get paid. If they don't get paid, they're getting nothing, right? They've done all that work and they're not really getting compensated for all the work they've done. So they're going to push to get beyond that hurdle, beyond that pref. Now, why would somebody take a lower pref, 7%, instead of like 9% in a riskier position? Well, ultimately because that riskier position has more upside. The same reason why anybody would ever take a lower potential return that's more safe is because they want to have more potential upside, right? So a 70-30 split is a very fair, reasonable split. It's way better than having 70-30 without a pref, which I've seen, right? And 70-30 without a pref, those GPs are getting paid very well, and they don't necessarily have to do much to get that money. So at least you're still getting a preferred rate of return, and you still have a lot of upside. In a typical deal, the amount of upside at the end approximately equal to the amount of cash flow that you have received during the hold of the asset. So if you're getting like 7% per year for 5 years, then at the end, when it sells, you're going to get another 35% back. So that's like a 70% overall return over 5 years, average of 14% per year. These are average numbers. Okay, so having that upside at the end puts an extra $35,000 into your pocket. If you were to invest $100,000, get 77777 for 5 years, $35,000 extra at the end. And that $35,000 extra can help you pay for any of the depreciation recapture that will come to you on your last K1 for that deal in the year after it sells. Okay, and so then you get your principal back, you get some extra, the extra can pay for some of the tax liability, and you can invest it all into the next deal with your original principal plus a little bit more. And now hopefully you're getting more than $7,000 per year. And so that your cash distributions continue to grow because you keep reinvesting. That's basically the compound interest of investing with real estate. So your cash flow goes, you get a pop at the end, you invest the pop, and now your cash flow is bigger. Repeat over and over again. Okay, very tax efficiently. So that's why people would invest in Class B, because there's just a lot more upside. And having more upside, people want more returns, right? And if a 7% is a good position for you to be in from a preferred standpoint and have upside, that sounds great. I like 7% and 70-30, but I'd also have to think about how much is the split between those Class A and those Class B shares. If 80% of people are investing in Class A, your Class B shares are less attractive in one respect because you're less likely to get paid. However, there's actually a lot more upside on those Class B shares if most of the money goes to Class A, because Class A is taking out 9% ongoing, which is higher than 7%. So they're taking out a lot more of the cash flow. But at the end, when it sells, they're not getting any of the upside. So the potential return on that Class B ends up being really big because there's just not many people for whom to distribute that extra capital. That 70% that goes to Class B shares might not be a lot of people, but it could be a ton of money. Okay, so these are things to look at. The more Class A there is, the higher the IRR return is. I know that's supposed to say IRR return. It's like saying ATM machine, right? It's redundant. But the IRR ends up being higher the more Class A there is. So there's more upside, but there's also more risk because there's more people that need to get paid their 9% before you get paid any of your 7%. All right. So that is just the reality of what I have seen. That's what the market is doing. That's what the offers look like these days. And for whatever reasons, that's where it is. And that's what people are investing in. Maybe it's because there's more people who want more quote unquote safer investments and they're willing to take more cash flow with a little bit less upside. And then there's people who also might not have much tax sheltered money. So doing first lien position investing is more limited to them, and they're at a high tax bracket. So the net risk adjusted return just isn't as favorable. But it really just depends on your situation. I mean, if you're in a low tax bracket, 10 or 12%, then maybe first lien lending makes a lot more sense for you, especially if you want to have more safe position. Although first lien lending also does not tend to provide cash flow as much as it provides growth. That comes back to occasionally whenever a deal comes through. But if you're in a fund, they may provide more steady payments. One of the nice things about investing in a syndication in an equity position is that you tend to have more dependable cash flow on a monthly or quarterly basis, usually quarterly, but I've seen more and more sponsor groups do monthly distributions. And I think a lot of investors really like that, especially those who are using those monthly distributions for cash flow purposes, people who are retired and they're using their rental real estate syndication investment as one of their primary forms of paying their normal cash flow expenses. All right, so that is it for today's episode number 79. Thank you for joining the group, people who are here. Again, this is 100% for my entertainment, maybe your entertainment purposes only. This is not for legal, financial, or accounting, or any other advice. I am not certified in any of those areas. I'm only really certified to practice medicine and only within my state. So, there you go. I hope you enjoyed this. Please share with a friend. Please invite your friends into our community. Onward to 1,000 members. If y'all check out YouTube, if everybody wants to check out YouTube and see if the live stream shows up there, I've never actually seen it before, but I think this is going out there. And I'm going to likely transfer more of my videos over there as well. Until tomorrow, have a good one.